Of the top 20 stocks and options volume that have reported quarterly earnings so far, a few have significantly outperformed the S&P 500 and a few have materially underperformed. How are options traders positioning themselves in the biggest movers post-earnings? We're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the markets, options, and take some of your questions. Obviously, a big day today with the inauguration of the 47th President of the United States, once prior President of the United States, Donald Trump. And the futures are a little bit higher today. Part of the reason for this was that shortly after the inauguration, one of the things that took place was that the president signed a couple immediate sort of declarations, if you will, executive orders and so on. One of the things that a lot of investors have been concerned about, of course, were tariffs. And it does seem that they are taking a fairly deliberate approach, and in fact, they've indicated as much. And consequently, those markets that are open are trading a little bit higher on that news. So with that, since the market is closed today, I thought what we might do, because we're very early in the earnings season so far, is review some of the earnings that have already come out and talk a little bit about how options traders were positioning after they saw those results. So I think one of the areas where we saw some interesting divergences was in the regional banks. So Bank of the Ozarks, which is ticker OZK, this was the single best performing financial stock coming out of earnings so far. So, and I thought this was interesting because it actually speaks a little bit, from my point of view, to how and why you will get non-continuous prices in stocks in earnings. So, Bank of the Ozarks is not one of the best loved regional banks. In fact, it is essentially one of the most out of favor regional banks. And as a consequence of this, it was trading relatively cheap compared to its peers. And this is not a sector that is generally enjoying very high valuations to begin with. So for example, as a group, the regional banks, as we can see here, if I can blow this up a little bit. So I'm just going to, let's do this here so we can actually get a look at what I'm talking about. So if you look over here, where I'm putting this box right now, this over here is the multiple to forward price to earnings. And it looks like there's a little bit of a lag with my screen share, so please bear with me when you see this. Sometimes what I'm saying and what you see on the screen might not necessarily align exactly, so I'm going to try to take my time as I illustrate this. But as you can see, even net of the big pop that the stock had, about a 10% pop following earnings at the end of last week, you can see that as a group, regional banks are only trading about 13.7 times forward earnings. They're about 1.4 times price to book, which is oftentimes a nice way to sort of think about the valuation of a bank. Bank of the Ozarks is trading at a 38 and 26% discount to the group, as you can see here. So 26% discount to the mean for the group on a price to book value basis, and a 38% discount on a price to forward earnings estimates basis. So this is one of the reasons why I often say that I'm not very much in favor of selling covered calls going into earnings. Because if you have a situation like this one, and actually I think we can pull up here and show what the consensus was, we can see that the stock had 3 buys, 5 holds, 2 sells. And again, I'm going to try to blow this up just a little bit. Nope, that's not blowing up the right thing. Let's see if I can blow this up. There we are. So if you're looking in this upper left-hand corner, right where my cursor is, This consensus rating is effectively a number from 1 to 5. 5 being the most bullish and 1 being the most bearish. One of the things that you also will probably remember is that generally speaking, Wall Street is bullish. So if you look at sell side, most stocks, there are going to be more buys and holds. It's very rare to see stocks that have more sells than buys. And a hold is often kind of code, if you will, for a sell. The idea is that it's not a stock that they would recommend. Nobody's capital is infinite, and therefore, if you're thinking about stocks to own, this probably wouldn't have appeared very high on the list. And the net effect of this was that there was quite a lot of options activity in the name. So this thing trades about 1,800, 1,900 contracts a day on average. It traded almost 10,300 on Friday. And we can see here that the average call volume, around 1,220 contracts, traded 7,600. And if we take a look, what we can see is that there was a lot of activity in these in-the-money call options, these February 40 and 42.5 calls. And we can also see that there was open interest here, 1,900 of these Feb 40s and 1,100 of these Feb 42.5s. So let's just take a quick peek at this for a second and see what was going on. It looks to me like somebody right here, if you're looking at this lower chart, so the lower chart here is the increase in open interest. So this is in and around the time that whoever was in these calls put them on. And the implied volatility data suggests that these may well have been covered calls that were sold. And I'm sure that the reason for that was that at the time, it probably seemed like a fairly juicy bit of premium to get, right? So we can take a look here and see where Ozarks was. So we're right in this neighborhood down here. And now, of course, the stock is significantly higher. So early January, the stock was about $40. So these things were, you know, they were rich relative to the stock price seemingly, but then when you take a look at what happened after earnings, you can see that if you happen to have sold these, that didn't turn out so hot. Now, obviously, if somebody was trading these things on the long side, then that obviously was that worked out probably just fine. Now, I would also say we should probably just take a look at the higher strike calls now to see how people are trading out of the earnings result. And we can see that there was a decent bit of activity on the April 52.5 calls. I think that's probably the most realistic calls that we are seeing trading. Some of this other stuff is just trading volume, but in terms of people who are making a longer term view, risking $1.40 a share on a $50 stock, to make bets that the things rally could continue. And remember, it's still trading at anywhere from a 25 to a 40% discount, round numbers, relative to the group. Okay, so not a space that is completely out of the woods, but because they had gotten so cheap, because the sentiment had gotten so overwhelming, and we got an 8.6% in Ozark. Okay, so apparently I am breaking up. So how's that sound going now? Does that sound all right? Hopefully. Just getting some complaints from the production staff, the crack production staff on the East Coast here. Now, okay, so let's move on a little bit. Other banks that saw some upside included Truist Financial, which is ticker TFC. Sort of a similar story here to Bank of the Ozarks. Not overwhelmingly popular name. And, we can take a quick peek here and see this one was a little bit more positive. And you can see this little green triangle in the upper left-hand corner. That simply indicates that within the last 30 days, the direction of analysts a change in their rating. So this just simply indicates that one or several analysts have raised their ratings within the course of the last 30 days. But still, this is not, we have more holds than buys, so not overwhelmingly positive. But again, this kind of speaks to the coiled, what I sometimes refer to as a coiled spring effect, that if everybody's getting very, very bearish on a name, you can get into a situation where any kind of a positive upside surprise and the stock can move meaningfully higher. Okay, so advancing to some of the other names that did, I think, very, very well. We saw sort of in the major bank space, BlackRock had, I think, impressive results. Maybe not as impressive as some had expected, but they gathered a tremendous amount of assets. A lot of that, Larry Fink was being interviewed. I can't remember whether it was on CNBC or Bloomberg, but he was talking about, I think, the $280 billion in incremental assets under management that BlackRock gained over the course of the last quarter. Some of that was the result of acquisitions. So BlackRock will, from time to time, acquire other companies. Morgan Stanley, another big asset manager, that one did quite well. And, so we were seeing a lot of bullish activity coming out of these stocks as a result. Now, on the downside, and I would say that those two regionals that I was just talking about were pretty much the least favored regional banks. The more favored regional banks tended not to do quite as well. So, for example, M&T and Regions Financial both fell following earnings and have underperformed the S&P. Now, of course, we're only a couple trading days in because these things were very early in the earnings season. I think 100 of, in round numbers, about 100 of the Russell 3000 stocks have reported, and most of those are going to be, the most notable of those are the big banks. There was some other things going on, though, that I thought was kind of interesting. So in addition to Morgan, Goldman, all of those doing very well, in part because we had that elevated volatility at the end of last year that contributed to trading profits, Wells Fargo did quite well. Some of the other areas that saw some results that are worth paying attention to, I think, and it's interesting because shortly after the president was sworn into office, he gave a speech. He talked about inflation. He talked about energy's contribution to inflation, and maybe more in what seemed like a campaign speech almost. He said that we're going to drill, baby, drill. Well, I think we have spoken a little bit about the fact that oil production, energy production, so barrels of oil equivalent at about 22 million, and actual crude about 13 million barrels a day. So this is essentially all-time records for the U.S. But that is a positive. And then Schlumberger posted a modest 2.2% earnings beat, and the stock rallied more than 6%, as we can see here. And we saw a decent bit of options activity. Traders are betting that there's more room to run. We can take a look at the flows that we were seeing over here. The March 42.5 calls were the most active contract, over 11,000 of those traded hands. I think what was the average price on these things? Again, not a bad way to make a post-earnings bet on continued strength. You have momentum at that point. I don't know that we actually got, there is a big downtrend here, and I'm not entirely convinced that we've completely come out of this. Oops. That is plotting the call, not the stock. Well, we might be. Let's just draw some lines on this thing and see what this looks like. We might have emerged from that. Let's take a quick peek. We'll put some lines in here. So Look at that. To the penny, as Carter Worth would say. Well, that does look like a little bit of a breakout, doesn't it? So, yeah, they were buying effectively the 42.5 calls in March. Not a bad way to play for continued strength. And to the extent that there can be any incremental investment and development in the space, we can probably anticipate it here. So there were a couple other names that I think deserve some mention. I've talked about some of them here in the past. Unitedhealth I thought was rather interesting. So this one got pretty hard hit, and we saw above average put volume. We can just take a quick peek here. So a couple things happened. Their revenues came in a little bit light. The payout. So one of the things you care a lot about when you're talking about an insurance company is what percentage of the premiums you collect go out the door in terms of payouts. And that came in slightly above the street's expectation, so that was viewed to be a negative. That said, this is not a particularly expensive stock at this point. As you can see here, it's trading at a pretty good discount to the market more generally. And I'm not going to suggest that this is not a sector that's going to face some scrutiny. I think they are going to be facing some scrutiny. But this is getting closer to the bottom end of the valuation range that we've seen. So just to make a fairly clear point of it, I'm just going to draw a line here where the valuation is. Think about this green line. That's really the thing that we're worried about. So let me do this again. So this is where we are right now. Has it been cheaper? It has. It was obviously cheaper in the pandemic plunge. I think we can sort of eliminate that from consideration in terms of how we think about things, as we probably should for most stocks. You could say, for the sake of argument, that, okay, maybe it trades down to this late 2019 valuation that we saw here. We'll call that, 16-ish. So if I look at that as the potential downside, then you could say, well, all right, that's, worst case, 15.5%, 16% downside in the stock versus, and I'm not saying it's going to get back up to this higher valuation either, but, given the company's growth, given the company's free cash flow, which is substantial. I think a lot of people don't recognize this, but you can take a look. The full year forecast for free cash flow for Unitedhealth is just shy of $30 billion. So this is another one that I think is probably worth a look. And one final area that I think deserves a little bit of attention are truckers. We saw that there was some pretty negative activity in that space. So JB Hunt, we can see here. Now, I'm not going to get into the truckers too much, but I did want to say this. I think I brought them up when we were talking about Federal Express and FedEx talking about the fact that they were thinking about spinning off a portion of their trucking business. And at the time, in fact, actually, we did talk about it on CNBC. I remember Karen was on that day, as was I, and folks were talking about whether or not the company was being appropriately valued on a sum of the parts basis. And I made 2 points. One was that I didn't think it was a hugely material percentage of FedEx's business. But the second was that I also felt that it wasn't so much that FedEx might be undervalued if we took a look at their, intermodal trucking business or whatever. It was probably more that that business might have been slightly overvalued. And I was struggling a little bit to understand why some of these names were trading at the multiples that they were at the time. As we can see here, this thing's trading 30 times forward earnings. And these are not, the most stellar growth companies in the world. you can take a look here and you can see what the top line is. Forecast is for less than 3% top line growth for JB Hunt for full year 2025. Okay, so with that, there was a question, and I don't know if we're able to bring it up. It was the question. I'll read the question, and then hopefully someone will be able to bring it up. Hi, Mike. For a stock which has released earnings, what information do you consider earnings, forecasts, etc., and your resulting stance, bullish, neutral, or bearish, and option strategies in each case, day after earnings? Okay, so a couple quick points I would like to make about this, and I thought it was a great question. So that question came in well prior to us going live today, and I didn't know how many people were going to tune in anyway, because it is obviously a trading holiday. But because we did see some interesting results last week, I thought it was worth a mention. The first thing I would say is, remember that I've spoken about the 3-day rule. The 3-day rule is not so much a rule, kind of as Captain Barbossa said in Pirates of the Caribbean. You know, they're more rules than, or guidelines than actual rules. The idea is simply giving a stock room for institutional traders to position themselves, because they don't click trade, right? So it takes time to enter and exit positions. If news comes out that is generally more positive than the street expects, then institutional holders are likely not going to be sellers, and you could have incremental buyers, but that is going to take place over a course of some time. And the opposite is also true. So I don't necessarily try to catch the falling knife in a name like JB Hunt immediately following earnings, especially when I think the valuation is already a little bit stretched. I would instead be more inclined to use options to bet in that direction. So, as you point out, for Goldman Sachs, which had very good results, and that actually is consistent with the options flows that we've seen, that would be betting that this trend is the one that's likely to continue. And, you know, an advantage, you know, one of the nice things about this is that not only do you have new information immediately following earnings, and not only are most self-directed traders able to position themselves more quickly than institutions can, which is obviously a nice plus. You have this additional information. You also have the benefit of lower implied volatilities. So it is unfortunate to a degree that if you had, you know, been inclined to make a bearish bet but didn't ahead of time, that you missed the $13 pop in the stock that it enjoyed on Friday. But in contrast to that, you also are going to be paying a lower implied volatility for, that is to say, the amount of premium that you spend, all else equal, is going to be less coming out of it, and you have more information. So let's just take a look at that very quickly, and we can take a look perhaps at February regular way options. I think that's probably and I haven't looked at these yet, but you know, we might as well just do this together. So stock is, let's just say for the sake of argument that you had purchased, you know, these 625 calls ahead of earnings. Obviously the stock's up nicely. That's a big plus. But implied volatility is also going to come in. So this is the day prior, 1142. Now they're 1875. Now the stock is also up $13, so we can just take a quick peek now at, say, buying a slightly longer dated option instead. Now that you have this additional information, go out at least 60 days or so. Maybe you want to buy a 40 delta call or something like that, or maybe a call spread. So that's going to be something like these 640s. This is probably the way I would be inclined to play it. You could also do something like a call spread risk reversal, try to reduce your costs a little bit further. And why do I say this? Because you can be more comfortable selling that downside put. And remember what I've said before, call spread risk reversals, short puts, buy rights, these are all trades of a very similar characteristic. You know, they will tend to have a limited amount of upside, but they have a bullish tilt. And downside, obviously, if the stock falls out of bed. But that's not likely now that the catalysts that would propel it materially in one direction have come and gone. So, this is a situation where I think, doing something like call spread risk reversals or call spreads in the money call spreads also are fine. And frankly, if you own the stock now is actually not a bad time to contemplate writing covered calls against it. Just make sure that you give yourself a little bit of upside room to it. So, yeah, I think that immediately following earnings, especially on the downside, don't try to catch the falling knife. That's the first bit of advice I would give. And, other than that, you can wait 3 days or so and sort of see where the institutions settle in. Okay, so, all right. Eileen says, do you have a favorite technical indicator? I recently learned about, did I share this? Well, so, yeah, let's take a look. So I tend, because as you guys probably know, the thing that I care about most is first what I think the fundamental story for a stock is. And from that point, I'm just looking at general trends and I have a longer term point of view. So if you're looking at, Williams, for example, this percent R strategy, you can see that in the case of Goldman, and I'm just pulling up Goldman because this was the name we were just looking at, this is one of the better performing strategies over the course of the last year. So, I will look at long-term trend lines and longer-term moving averages. I look at the 150. It's just sort of it's basically a smoothing mechanism, as Carter likes to say, and it makes good sense to me to sort of think about that. I do also do things like we were just doing before, trying to take a look at Schlumberger to see whether it was breaking out of its downtrend. It looks like it rather definitively has. But beyond that, I will often go to this page and just see which technical indicators appear to be working. And this is, each of these I should add has sort of a default setting, so these things can be modified and you can then rerun it. But as a general guideline, I like to sort of take a look and see how these are performing on a relative basis. I haven't really used this one so much, but as you can see, you seem to like it. And in some of these names, let's take a look at something more general, like the market overall, and see how it's doing in that context. So MACD is actually outperforming, but both have negative results over the course of the last year. If we go back to pre-pandemic, so now we're going to look at a 5-year period and see which ones were working best for the broad market, other than buy and hold. Is the market's enjoyed stellar returns, so it's probably not that surprising that you've had these exceptional results out of just a simple buy and hold strategy. But Ichimoku and triangular and exponential moving average, as well as MACD, do appear to be the best performing ones there. So, people can pick their poison, because usually this is going to be just one of several inputs that you're using. There's a lot of tradable securities out there. Presumably you're doing work outside of just technicals in making your decisions. But, truly some technical indicators work better in some contexts than others. So I hope that helps you. I've noticed fear and greed when you pull up Bloomberg. I wish Yahoo Finance had that one available. Admittedly, I don't know exactly what Yahoo Finance has. I should probably spend a little bit of time taking a look at some of these. And, I mean, there's what you've seen on the Bloomberg terminal, I have to say, is just barely scratching the surface, because this thing has so many functions and so many different contexts. Markets all the way around the world. Almost everybody I know who uses it, because we tend to focus on certain things. We have a handful of functions that we're used to using. But, you know, if there are assets outside of what we usually discuss that folks are interested in, let me know, because there's almost certainly going to be some valuable information in here and analysis tools as well. Jay Bao, today President, I don't know if I'm pronouncing your last name correctly, Jay. Today, President Trump said to send an astronaut to Mars within his term. Is Tesla the best bet on this? That's a very ambitious goal, I would say. Now, of course, he and Elon get to chat. So, you know, maybe such a thing is possible. It strikes me as awfully ambitious, though. The distance to Mars from the Earth compared to the moon, we're talking about orders of magnitude. And, you know, the amount, I don't know. Like I said, I guess I would have to say that if I was going to gamble on whether or not we were going to get a man to Mars, I don't anticipate that is going to happen before Trump leaves office. That said, it would be hard to bet against Elon on that. So, yeah, I guess. Yeah, I that's a tough one. I'm not sure I really have a good answer except to say that I think it's kind of unlikely that that's going to happen. I mean, it's something like 140 million miles away. Maybe somebody can get in my ear and tell me exactly what that distance is. But it's so much farther than the moon, it would take a very long time to get there. I just don't know. There's a lot more than just coming up with a rocket that's capable of the trip in terms of sending a manned mission to Mars. That also strikes me as monumentally expensive. I rather favor private industry making material investments in space travel, because that they then have to evaluate the relative economic merits of different approaches, and frankly of any undertaking. They have to sort of come up with the net present value and decide whether or not it's worth doing, outside of, you know, the individual desire of people at the top of the companies like Elon or Jeff Bezos, or others, to Richard Branson. You know, there's a number of billionaires who are very interested in space travel. But I'm kind of hoping we don't turn it into a massive... It would be kind of an interesting pivot from the Department of Government Efficiency, which was so touted ahead of the current administration's arrival, that it would fall as a burden on the taxpayers. So I'm kind of hoping that's not the case. Of course, whether or not that money gets spent is also going to be largely up to Congress. But yeah, some questions about that. 30 times the distance of Earth to the moon is what Jay is saying. Yeah, that sounds... Well, actually, I for some reason thought it might be a little bit more than that. I thought it was more like 50, but I'll take your word for it, and you guys probably have the ability to look it right up. So it's a big deal, and you know, Bezos and Elon, I would say, are the two that are in the lead. SpaceX, I saw, had the valuation of about 350 billion in the private markets, and perhaps there's going to be a way to make a more direct investment in it when the time comes. I would have to say, though, that if it's a trip to Mars that you're speculating on, that's exactly what it is. It's quite speculative. Okay. So, Bob, congrats on winning the 2024 CNBC acronym challenge. Well, thank you. Many of the, I should point out, and if you missed some of the most recent live streams, I would point out that many of the underpinning sort of ideas I had in support of the BRAVE acronym at the beginning of this, really the end of 2023, I think, is when CNBC approached me about it and got released in early 2024, remain intact. I'm not, I would not recommend, for example, people who hold Bitcoin selling it at this point. My 2025 acronym Rising, the first I in that is for IBIT, and that was simply because it's, fit the acronym. IBIT is the Bitcoin ETF, but I'm not suggesting that people who hold Bitcoin should pivot into the ETF, or if you have other mechanisms by which you're getting long it, that you have to necessarily use IBIT. But it's the general principle of the thing that I remain bullish on that. The other thing that I had brought up at the beginning of 2024, I think also remains true, which is that, there are a lot of stocks that have not performed as well as the broad market. And consequently, so Tracer Tube is saying Mars is over 30 million miles away, with the moon only 250,000 miles away. So, so that would be more than 100 times. So you guys can all contribute. I'm sure you guys have access to your Google machines. You can look this up or go to ChatGPT. But I will say, it is not, it's not an immaterial difference, and I think it's quite unlikely that we're going to get that within the next 4 years. Okay, so moving on from that, though, the principle that I had in the 2025 acronym remains that there are stocks that have not performed as well in terms of price action, but have performed very well in terms of their operating profitability and revenue growth. And it is for this reason that I recommended RSP in favor of SPY, because you are getting, over the long term, you're getting fairly comparable rates of earnings and revenue growth, but you're getting it at a much cheaper multiple. So if you're going to go out and buy a business right now, this is what you're doing when you're buying stocks, you're buying businesses. All else equal, you would favor buying the ones that are cheaper, for comparable levels of growth and diversification. So RSP has greater diversification in a sense. It's equal weight. You don't get the benefit of, the massive and shocking earnings growth that you might get from, the largest constituents of the S&P right now, for example, NVIDIA. So if you have a stock that's 6-7% of the underpinning index, and they manage to double their earnings from one year to the next and the next and the next, that additional weight has benefits. But you can look at it a different way, and I would urge people to think about this, which is that, NVIDIA was a much smaller constituent, and it had stellar rates of growth. So, if you're going to wonder what the next great thing is, the equal weight ETFs are more likely to give you more weight to the up-and-comers, because you're going to weight the smaller businesses more heavily than you would in a cap-weighted index like the S&P. And really, it just comes down to the broader trend, which is that if revenue growth and earnings growth are comparable for both indices, which they are over a long period of time, if they tend to trade in parallel with each other, which they generally do, and if the valuation multiples of these two is not... there's a follow-up question on the Rising acronym, I guess. Let's see. Okay. You set the bar for traders to perform with 30% plus in 2025 to win. Yeah. I think the return for the acronym, the total return, so that would be net of reinvested dividends, was 34.9% in 2024. Do I think that the rising acronym can gain something like that? So, look, yeah, on any given year, who knows, right? So 30%, 34, almost 35%. It's tough to replicate that unless you are a member of Congress. It seems like a number of them are able to get these kinds of results, which is one of the reasons why N was in the acronym for Nance, as in Nancy Pelosi. That is the subversive ETFs, Democratic members of Congress tracking ETF. So basically they take a look at the filings of members of Congress. There is also one for Republicans called Cruz, Kruz, presumably named after Ted Cruz. But the Democrats haven't performed anywhere near as well as, the Republicans have not performed anywhere near as well as the Democrats have. And Nancy in particular has been sort of top of the heap there. Would make an exceptional hedge fund manager. I don't know. 30% is pretty ambitious. Obviously, I'd be very happy to get 30% back to back. More than 30% increases would be great, but kind of thing's pretty rare. So I'm not going to suggest that I have any guarantees in this. So let me just go over what's in that. So R is for, because somebody else is asking this question, R is for RSP, which is the equal weight S&P 500 ETF. The first I is for IBIT, IBIT, which is the Bitcoin ETF. The S is for SCHH. SCHH is a REIT ETF. And this is just because I realize that some investors are looking for income. And if you are a hodler on the crypto side, then presumably you're looking for your income from another one. And my thinking on REITs is that the victory against inflation probably shouldn't be declared too early. And of course, if inflation rears its head, that's not going to be good for REITs necessarily, but you will be getting income from them. And the underpinning assets of REITs, with a couple exceptions, generally will rise with inflation, which is not true for fixed income in the form of, say, a bond. So if you don't get, if the underpinning assets are going down because inflation is rising, so the net present value on your bond is going down because the principal is being degraded by inflation. At least with a REIT, that's not happening. And that was one of the reasons why I rather preferred that as a mechanism to collect some income. And, frankly, the dividends on these things are quite good. I think on SCHH, I'll look it up just to be sure, but I believed it was just, when I was looking at this before, it was just under 5%. 4.6%. So 4.6% dividend yield, not bad. One quick point I would make, and that is that not all of the underpinning assets necessarily are going to do that well. So if you're in public storage, which is down here, or Simon Property Group, or Avalon Bay Communities, the residential apartment manager, those things are all going to be assets which, of course, are going to depreciate to a certain extent, just wear and tear, conventional amounts of maintenance. But those, as assets, those aren't really depreciating in value. That's a little bit different for something like an American tower. So I think it's important to remember that, if you're operating mobile phone towers, as technologies change, those things do need to be replaced. They degrade over time, and then the technology is no longer good. So there is continuous capital investment that has to go on in those portions of the business. But some of these other things actually have decent, they're hedged somewhat, if we can say this, against inflation, because the underpinning assets are going to rise with it. Okay, so the second I is for the ETF INDA, which is the India, and I shouldn't say the India ETF, I should more fairly say an Indian ETF. Modi, I mentioned this, he he was speaking to a number of students in New Delhi. It was, 8 days ago or so. And, the general forecast is that the Indian economy is probably going to be about 10 trillion US by 2040. And to put things in perspective, that is an annual growth rate of, I think, 6.3% or so. And that's quite good. So, you want to invest in economies that are growing, as I've often said. This is a diversified way to do that. Making direct investments in Indian stocks is not very easy. When I was at Cantor Fitzgerald, we had a lot of customers that were interested in investing in stocks in India. You had to have boots, what are called boots on the ground. So you had to have a regional office. I think we did have one, but I just remember it was extremely clunky to try to make direct investments in Indian equities. Even as an institution, it was not that easy. So using something like the INDA ETF is probably not a bad idea. Okay, so RISI. Oh, yes. Okay, so that leaves us with, well, actually, the question here was for Google, Alphabet. I mean, look, the thing is, here's my thinking about Alphabet. If it can keep up its top-line growth and EPS growth, it's been outperforming the S&P generally. It's trading about 4 turns cheaper. So my thinking is that it deserves at least an S&P multiple if it can continue to deliver that kind of performance. And so that would be, even conservatively, we're going to say that means that it deserves, let's call it 2 to 3 turns on earnings, which are forecast to be $116 billion for next year. So, we're going to tack on $232 billion, and that's just so that it trades to the market multiple at least. So that's a 10% gain plus whatever the S&P can give. Something like that is kind of what I would expect. So just some sort of valuation convergence there. I kind of feel that it deserves to trade at the S&P multiple at least. And, that's going to create an 8 to 10% relative boost. So whatever I think the S&P is going to do, I think that Alphabet deserves to get an extra 8 to 10%. That's kind of the way I think about it. I hope that helps. All righty then. So let's say, okay, tracer tube, Mars is 30 million miles away. And then, like I said, I thought it was like 140, but someone is in my ear telling me that it is close to that number. It's 140, so that's very, very far, and I don't think that's gonna happen. YouTube may benefit if TikTok goes dark again. So this is an interesting one, right? Because so what has to happen here is that China has to divest. TikTok US doesn't have to be an asset that goes to zero. They would need to dispose of it, though, and sell it to, perhaps a US-based company. And, yeah, I mean, it's a big boost to Meta, in my view, if they can't come to some form of an accord. Because I kind of feel that, maybe the Instagram is probably going to try to pick up the slack somehow. And actually, there was a bit of a boost that Meta got on the back of that news after, there was a ruling that indeed they were going to have to get shut down. So that's probably worth a mention. But could potentially be a bit of a benefit for X, I suppose. But X is a private company, not really a good way to invest in that necessarily. Okay. eSmith 23. BlackRock has been no better than a market performer over the last 3 to 5 years with higher volatility. Any suggestions for a long-dated collar trade? Yeah, well, let's take a look at this. So first things first, let's take a look at the volatility of BlackRock versus financials and the S&P. So what I'm just going to pull in here, so I'm just going to look at the realized volatility. We'll get to look at 30-day. This is 30 trading day, by the way. We'll put SPY as a proxy for the S&P. And I guess we could use XLF as a proxy for financials. And let's just take a look. You were saying the last 5 years. Well, first of all, I'm going to just throw this out there, which is that the pandemic plunge was one of those things where a lot of, financials got particularly hard hit because there's a lot of leverage on those balance sheets. So it does appear that the volatility of BlackRock has been pretty consistently higher than the S&P. That's not that uncommon. The S&P is a diversified index. In some ways, I would have thought that an asset manager wouldn't have so much higher volatility than, say, regional banks, which have, significant risk on their balance sheets. I mean, we've seen just how significant that risk can be when you look at Signature, when you look at Silicon Valley Bank and some of the other failures, Republic, First Republic. Those institutions clearly had a lot more risk than BlackRock does, or Morgan Stanley, which is another asset manager. And now we'll just take a quick look at their performance. So this is, again, going back 5 years. So it's outperformed, the total return has outperformed the S&P by 18%. And it's outperformed financials more broadly by about 24%. So, whether or not you think that's, sufficient for the incremental risk you're taking, I mean, they're just an absolute powerhouse, but, maybe I can see why some people just don't want additional risk and volatility. I can understand that. So let's just take a look at some collars or other ways that you can get into a bullish position. So the fact that you mention a collar makes me believe that you already own the stock and are just a little bit dissatisfied with how choppy it's been. So the nice thing about collars right now, as I've previously pointed out, is that in a higher interest rate environment, you can get an asymmetric payoff. And this is not an arbitrage. It's not to say, as I've previously pointed out, this isn't free money. You are committing your capital to being long a stock instead of having it in cash, and cash pays more in interest than it has done in the past. But the fact is that most people do own stocks, and you're going to own them anyway. So if you can structure that position in a manner that gives you an asymmetric risk reward, then by all means. So here's the long stock position. If we added a collar to it, so you would be buying a downside put, selling an upside call. For tax reasons, it's generally probably advisable to try to get, out into the new year at least, but maybe you could go a little bit further, but we'll just go to January 2026, so 1 year away, and take a look at that. So if you were going to say, give yourself a buffer down 10%, it's going to be these 900 puts. And, the calls you would sell against that for about even money would be the 1140s with the stock at 1,000. And you end up essentially with this, which is synthetically equivalent to a long in the money call spread. And in this case, you have 10% downside versus 14% upside. Now, if you feel like that's not enough upside, and I can understand why some people might feel like it isn't, because a lot of times investors' expectations are set by what has happened relatively recently. And recently we've seen, I don't think we should become accustomed to back-to-back years of greater than 20% returns the way we have done. But let's just say that you are saying to yourself, well, that's what I'm thinking. Well, then you would go to the 1200s to give yourself that kind of upside, and then you would just simply look to choose a put that costs something similar. So that would maybe be these 830s here. So that's going to give you $170 worth of downside risk. Actually, I can go, let's choose some mid-market prices. We can go like this, because you do want to be very careful with these longer dated options. So that's actually going to be more like this. So you get $150 worth of downside for $200 worth of upside at very close to even money. And that asymmetry is a function of the fact that your cash, were you to invest in, just leave it in a CD or put it into an interest-bearing account, you're going to be earning probably north of 4% over the course of that year. So that's $40, right? If we think about it like that. Okay, let's see. So I hope that helps you on that side. And what do we have here? kTOS just received $15 million of $100 million to develop a supersonic missile for drones. Is this the time to take a position or option trade? I do not think they are profitable yet. Well, let's see what their profitability looks like. They are. Company is profitable as of, so last 12 months, just under 15 million. They are going to be reporting on the 13th of February, and the expectation right now is that for full year 2024, they're going to do just under 73 million in net income. So let's take a look at some of these multiples. So the expectation is for a 25% year-on-year EPS growth, 12% top-line growth between 24 and 25. Trading pretty rich at 56 times. I have to say, and I think this is worth noting, so Palantir is talking about directed energy weapons against drones. That strikes me as a more practical approach. Now, Palantir is also not cheap, so let's be very clear about that. This thing's even more expensive, but they are growing the top line faster. And their approach, I mean, I agree with you. I think drones are one of the most material threats in modern warfare. We have seen their efficacy on the battlefield in Ukraine and Russia. So they're using basically armed FPV drones in these kind of suicide missions where they have explosives on drones, and then they are piloted via FPV. And there's a lot of good videos. You guys can check them out, where these things are, for example, chasing down Russian tanks and trucks, and then colliding with them. And they're remarkably effective, and they are effective, scalable, and inexpensive. So this is a form of warfare that, of course, everybody has to be up to speed on. But the technique for fighting that kind of war cannot be one where the solution that we develop is materially more expensive than the weapons that they are using against us. I'm using the U.S. in a defensive scenario analysis here. And missiles to take out drones in this way is not going to be cost effective, because each of those missiles is going to cost materially more than the drone that we're defending against. And that's not effective warfare. So I think directed energy weapons are probably better. Palantir apparently has this already. They can concurrently take out 100 unmanned drones with this technology, reportedly. And they are in a friendly position, I think, to advance their approach to modern warfighting in sort of the legacy of defense contractors, and probably not the most innovative approaches, and the Pentagon. And some of the criticism that's been leveled against the conventional defense contractors, and I hadn't really thought about it much, but it is a fair criticism, which is that if you have defense contractors operating on a cost plus model, meaning that they're building things on spec for the Defense Department, and they have a defined profit margin which they're permitted to essentially charge the government, and therefore the U.S. taxpayer. The question is whether that's an appropriate alignment of incentives in terms of coming up with the best and most cost-effective technological approaches to fighting modern wars. And the answer is it isn't, because they make their money the more of anything that they sell. So a missile, a defensive missile against a drone, if the missile costs $500,000 against a drone that costs $5,000, that works out just fine for the defense contractor. But it doesn't work out very well for the U.S. government and the U.S. taxpayer. I feel like the approach that Palantir is taking is the better one. There was a period where they had to educate the Department of Defense and others, probably members of Congress, and frankly, people, the citizenry needs to be aware of how their money is being spent and what is an effective way to do this. And I'm kind of a big fan of Palantir in this respect. I'm a little bit concerned about the expense. This thing is trading at 140 times, more than 140 times full year 2025 earnings. That's pretty chunky. But to put things in perspective, why don't we just compare it to Lockheed and ask yourself, could this company get to the size of Lockheed? So Lockheed is a $70 billion in terms of revenues business, which is 20 times bigger than Palantir is now. So if we're saying it's trading 140 times, but could they get up to this same size? I suppose they could. I like the approach that they're taking, and that's what you're betting on. If you own Palantir, I wouldn't necessarily recommend selling it because they're doing everything right. It's a very tough one to chase, though, for me, just because it's had such a strong run. But I will tell you that I think their approach is the correct one. I think they will benefit, and I think that we as a country will benefit if we have a more practical approach to how we spend our defense budget, and just understanding that we need to be more judicious about that. So I think with that, I have managed to chew up the full hour that we normally allocate for these things. I will be back on Wednesday at 4:15. If you have any questions, you can join us then and put them into the live chat, or you can put them into the YouTube comment section after this video, and we will review those questions, and perhaps we can get around to it. And we are also going to be talking on Wednesday about some of the other companies that are going to be reporting early this week and are scheduled to report over the course of the next 10 trading days or so. I think that should be well worth watching and thinking about. Thank you all for watching.